Hello, I'm Russ Mould, AJ Bell's Investment Director, and today I'd like to briefly talk to you about the referendum on EU membership that's planned for the 23rd of June. And in particular, I'd like to look at what the two possible outcomes could mean for you and your clients' portfolios. The first outcome is the UK population votes to stay in the EU and preserve the status quo. In this event, it's possible, logical that, first, the pound rallies to regain some of the ground it's lost against both the euro and the dollar in recent weeks, as per this chart here. Second, gilts see prices rally and yields go lower again as uncertainty is removed and UK government bonds retain their haven status, especially as there's less danger for overseas holders of the paper if the pound rallies. Third, the stock market, well, that could be relatively unmoved, although there may be a relief rally again as any uncertainty is removed. After all, Prime Minister Cameron would find it hard to survive a defeat in the vote, possibly prompting a Tory leadership contest. The Scottish National Party would also argue an exit represented a material change and potential grounds for a second referendum ballot on independence. Both votes would increase uncertainty rather than lower it. That said, there are no guarantees. The UK stock market went down after the Scottish vote before launching a 6-month rally that itself petered out quite quickly. The FTSE All-Share even peaked very shortly after a post-election jump last spring when in theory a Tory victory may have been seen as a good thing. So it's hard to be dogmatic about the potential impact, particularly as the UK market bounced on the day after the referendum was announced anyway, on the Monday. And that's also the case as the in and out campaigns differ hugely in their estimate of the negative or positive effect on UK GDP. But it seems possible in the event of a vote to leave the EU that, first, sterling would slide given the uncertainty caused by the lengthy exit process and subsequent trade negotiations. Second, gilts could wobble, as the 10-year yield of 1.4% is, well, pretty skinny and could easily be wiped out by falls in the pound if you're an overseas holder, and a third of the gilt market is owned by foreigners. This is important. The UK runs budget, trade and current account deficits. We bring in less than we earn and are therefore dependent on funding from other countries. If they take fright and stop buying or holding sterling assets, well, that could be awkward. In an extreme scenario, and I stress extreme scenario, it could even hit the pound so hard the Bank of England had to put up interest rates to defend sterling following a Brexit vote to leave. Now, it's hard to see a repeat of the sterling crisis of 67, 76 and 92, but it is worth bearing in mind this worst case, although Governor Mark Carney from the Bank of England may even be pleased to see the pound go down. It could boost inflation and exports after all. So from an equities perspective, thirdly, if sterling does fall, analysts at Avalon Capital Markets argue a selective approach to the UK market could be needed, as a weak pound would normally bring potential winners and losers. In the event of a plunge in the pound and a rise in rates after a Brexit vote to leave, they suggest UK domestic players like retailers, property, house builders, financial services and print and broadcast media, well, those sectors may lag. Equally, Avalon asserts that sectors which are heavy exporters or have a big chunk of their assets overseas may benefit. That potentially includes aerospace and defence, beverages, tobacco, personal goods and even the downtrodden mining sector. Now, if a client really believes that the referendum will see a vote to leave and that sterling will fall as a result, and that's in the end a decision that only they can take with you, the advisor's help, then another option would be to look at buying overseas assets either directly or through a fund, as their value would rise when translated back into pounds. However, any such trades of course bring risks of their own, including that those assets could fall faster in value than the pound does, leaving the client worse off than when they started. So, given the uncertainty in the huge number of variables advisors and clients face, well, they may well decide to do nothing. And that at least avoids unnecessary trading costs as the 23rd of June draws nearer. Thank you for watching, and I look forward to seeing you next time.